Today, we're going to break down an absolute masterclass on deep value investing. It's from a lecture given by the legendary investor Richard Pzena inside a class taught by another icon, Joel Greenblatt. So yeah, this is the good stuff. Let's dive right in. Right out of the gate, Pzena hits us with the bedrock of all value investing. And this slide, it says it all. This is based on decades of data, and the truth is just undeniable. Whether you use price to earnings, price to book, price to sales, it doesn't matter. The cheapest stocks have consistently, and I mean dramatically, outperformed the most expensive stocks. The evidence is just overwhelming. It works. And that, right there, is the multi-billion-dollar question. If the data is this clear, if there's a simple recipe for beating the market, why isn't everyone a value investor? This is the big puzzle that Pzena spends his whole lecture trying to solve. Because the answer, you see, has almost nothing to do with spreadsheets and everything to do with human psychology. And this quote from Joel Greenblatt, man, it just nails it. Value investing is brutally hard because it forces you to fight your own instincts. You have to buy what everyone else is desperately selling. You have to read these terrifying headlines about a company going down the tubes and then calmly sit down and write a check. It feels completely wrong. It feels crazy. And that right there is exactly why it works. So this slide shows the fundamental force that most investors completely get wrong: mean reversion. What does that mean? Well, look at the chart. Companies with super high returns on equity, the market darlings that everyone loves, they tend to become less profitable over time. And why is that? It's simple. Success breeds competition. Other people see those juicy profits and jump in. And on the flip side, really terrible companies often get better. The pull back to the average is like a law of gravity in business. And this is the critical mistake investors make again and again and again. They fall in love with a fantastic company and they just draw a straight line into the future, assuming it's going to stay amazing forever, that it'll somehow defy this law of economic gravity. So they pay way too much for it. A value investor does the exact opposite. They bet that today's dumpster fires won't burn forever. Okay, so this brings us to maybe the most important distinction an investor can ever make. We have to learn to separate the idea of a good business from the idea of a good stock. They are absolutely not the same thing. And if you confuse the two, well, that's a recipe for disaster. So what even is a good business? Well, Pzena gives this beautifully simple definition. It's just a company that can consistently make more money than the cost of the money it took to generate those profits. That's it. It's not about being in a cool industry, it's all about being able to defend your profits year after year. And how does the company do that? Through what Warren Buffett famously calls an economic moat, or what Pzena calls barriers to entry. This slide just illustrates the difference perfectly. On one side, you've got a business like Coca-Cola, protected by this massive brand they've built for over a century. And on the other side, you've got an airline. Where basically anyone with some cash can go lease a plane and start competing with you tomorrow. Those high barriers are what protect the profits. And here are the telltale signs of those strong barriers. This is the stuff Pzena looks for. Does the company have fat profit margins? Can it raise prices without everyone running for the hills? Is its brand a real asset? These are the clues that tell you you might have found a genuinely good business. Okay, so we know how to spot a good business. But here's the catch. The best businesses almost never go on sale. And that brings us to the real core of Pzena's strategy. It's this deeply counterintuitive secret to finding incredible bargains. Just let that sink in for a second. Value isn't created when things are getting better. Value is created by deterioration. The opportunity to buy a great company for 50 cents on the dollar doesn't show up on a sunny day. It shows up when there's blood in the streets. It's the bad news, the fear, the uncertainty. That's what creates the discount. This simple, hand-drawn chart from Pzena's talk, it's pure gold. It shows that most people, they wait. They wait for the business to stabilize or for things to start looking a little better before they buy. But by then, look, the price has already shot up. The true value investor buys here, at the bottom, at the point of maximum pessimism, while things are still getting worse. You're buying before there is any good news in sight. All right, so theory is great, but let's see how this actually works in the real world. In the lecture, Pzena walks us through his firm's investment in Lear Corporation, which is an auto parts supplier, to show this whole framework in action. Lear was just a perfect example of a company with two stories fighting each other. The bad story? Well, it was in a tough, cyclical industry, it was getting squeezed by its huge customers like GM and Ford, and its costs were going up. The good story? It had a fantastic reputation, it was a global player, and everyone trusted them. This conflict, this is exactly what a value investor is looking for. So the question is, was it a good business underneath it all? Pzena points to the historical numbers, and just look at this. Lear's return on invested tangible capital, basically a measure of how good it was at making money from its factories and equipment, was consistently over 30% for a decade. This, right here, is the smoking gun. Despite being in a tough business, Lear was historically a phenomenal company. So you see the puzzle, right? You've got a proven, high-quality business. We can see that from its past returns. And right now, it's facing this perfect storm of really scary, but maybe short-term problems. So the whole question is the business permanently broken, or is this just a temporary crisis that's giving you a once-in-a-decade price? That's the analysis. And here is where the theory hits reality. This chart shows Lear's stock price, and Pzena shows exactly when they bought it, September 21st, 2005. Not at the top, not after the recovery started, but right down here near the bottom when the fear was at its absolute peak. They were buying the deterioration, betting that the long-term quality of the business would win out. So how do we wrap all this up into something we can actually use? How do we find what Pzena calls investment nirvana? I think Pzena's own words just say it perfectly. The ultimate prize, the holy grail for an investor, is finding a great business, one with a real competitive advantage, that's on sale for a temporary reason. That rare combination of quality and price, that's nirvana. And this brilliant flowchart from the lecture basically summarizes the entire playbook. You start by fishing in the pond of cheap stocks. That's step one. From there, your real job is to do the hard work of separating the companies that are permanently broken from the good businesses that are just having a really bad year. That's where you add value. That's the whole game. Now, this lecture might be from 2006, but the lessons are completely timeless because they're based on market cycles and human psychology, and those things never change. So the final thought I'll leave you with is this. If you look at the market right now, today, which industries, which companies are completely hated? Where is the deterioration happening? And somewhere inside that pile of rubble, could there be a great business just waiting for a patient investor?